Happy 4th of July weekend to our United States viewers and to our SD Bullion customer base. We begin this week's SD Bullion market update with yet another signpost for bullish bullion bull market conditions building. This chart on the right-hand side reflects the yellow-colored gold spot price spanning the full fiat currency era, juxtaposed on the left-hand side by the recent crashing 5-year U.S. bonds real interest rate in the black line. Updated through the end of May 2021, we are once again in deeply negative territory akin to various timeframes during the last major secular bullion bull market of the 1970s. Here also note that we are only using the increasingly rigged U.S. government's consumer price index. If we use the old 1980 methodology for judging real rates of return on bonds versus actual price inflation, it appears the real negative rate on the 5-year U.S. bond is now near negative 12% annualized. This week, former hedge fund manager Jesse Felder on his podcast Super Investors had the following snippets of commentary on this negative interest rate environment for future gold values. Have a listen.
But I've been curious to really ask you more about gold because from just a fundamental standpoint to me, I'm looking at, the most deeply negative real interest rates that we've seen in 40 years. To me, that is probably the strongest case for owning gold that we've seen in a long, long time. And, it seems to me investors are just, are not appreciating the potential upside volatility in the gold price that we could see as a result of these deeply negative interest rates. Markets seem to be pricing in the transitory, Fed narrative on inflation. And if it proves to be inflation, a little bit more sustainable than transitory can accurately describe, then I think you're absolutely right. Then investors will, begin to appreciate that, heck, what stocks and bonds are not the place to, protect myself from, a Fed that's so far behind the curve that, we haven't seen anything like this in a long time. And it wouldn't take a ton of money to pour into gold to see it really take off. When I look at the relationship of, the real 30-year treasury yield, I'm talking about, 30-year yield less core inflation, and the gold price right now, we're so deeply negative on the 30 that it implies the gold prices should be up 30, 40, 50% year over year, and it's essentially flat. I mean, it points to a ton of potential upside for the gold price.
You still with me? Good, because we are now going to listen to a few quick snippets from who Jesse was speaking with on his latest podcast, Mr. Michael Oliver, a technical trader and investor who has been actively trading and accurately forecasting the financial markets from present day to all the way back to the year 1975 when he began, same year that gold bullion got re-legalized in the USA, and not coincidentally, the COMEX derivative gold contract began also trading. Michael Oliver has important points about how silver has been trading over the past near 1 year of time, and in longer term thinking, he also states what's really at play here and the big picture moving forwards.
And when you look at silver, it was a sideways trading range between 22 low. In fact, the 22 low in silver after the high last summer occurred within about a month of the high. And you've not been back to 22 cents. You've been living in the upper part of the range on silver. So they've been well supported. But if you think about the stock market and the psychology, look at the bull market in stocks for 12 years, so the S&P, and circle anytime you can find a 15, 20, 25% drop. You can find many of them. And yet, most of them did not generate extreme fear. Whereas in gold, every time you get a 10% drop, it's all over, right? So to some extent, as being bullish on gold, it's a good environment to be in, to have most of your long skeptical, because it means you're not over-enthused. We're not at the point where we have an overly enthused investor crowd. In fact, they're very doubtful. They run every time it says boo. But you're right. I think the real shock effect is mental, not so much chart-wise. It's when there's a realization that Ray Dalio made very clear when he said, be concerned about the value of your money in it. Okay. If all of a sudden we assume that the Fed might tighten in 2022, like they're talking about, that's based on an assumption that the stock market isn't going to be a problem. Well, what if the stock market becomes a problem and we see the Fed basically go back to full throttle in terms of their statements, because they've not come off full throttle, by the way, then that's going to cause a rethinking of all the investment strategies out there that are assuming, one, the Fed's going to tighten sooner or later, two, inflation is temporary, That's a false assumption on our view, looking at the long-term technicals of the commodity complex. And 3, that the dollar is going to somehow hold together. If certain of those things snap, it's going to cause a major upturning of the tablecloth on the table, and a lot of plates are going to break. And so I think it could be a fairly coincident event that occurs. And I think when that does occur and that realization hits people, that's when gold becomes the star of the show. And you're right, it's not that big of a market when you think about it compared to the global stock market,
On behalf of SDBullion.com, this is James Anderson with your week's SD Bullion market update. Before we continue onwards, please do me a favor of smashing the like button below so that more like-minded viewers can get this precious content served to them. If you like silver and gold bullion related updates, subscribe to our channel. We regularly publish compact, data-rich videos to keep our subscribers informed on the major precious metals markets. The spot silver price and gold price traded slightly up on the week. Gold-silver ratio tightened back to 67 to close this week. The Central Bank of Thailand made recent news in the gold market, having bolstered its official gold bullion reserves by likely the most of any country in the first half of this year, 2021. They added 90 metric tons of gold bullion in this past April and May 2021 and thereby boosted their gold reserves by 58.7% in a matter of recent months. In case you're wondering how much is 1 metric ton of gold bullion, it's about 80 of those 400-ounce gold bullion bars, a little over 57.6 million fiat Federal Reserve notes per metric ton at the moment. So the Central Bank of Thailand just gobbled up about 5 billion in gold bullion for the likely long term. And I know all this sounds like a lot to us non-fiat billionaires without printing presses, but let's blow that all away with what central banks and governments have been doing over the last 15 months of time. According to Bank of America's chief investment officer, central banks have bought $900 million in financial assets every hour over the last year and a quarter. That's $15 million a minute. Here's that displayed on a chart for context. Bank of America also cited that the latest Biden infrastructure plan for $600 billion in new spending takes the running tally of global monetary and fiscal stimulus to $30.5 trillion over the past 15 months, an amount equivalent to the entire Chinese and EU's GDP. That's a sum as well even larger than the USA's ballooning hard debt level at the moment. These and other contributing factors are no wonder why measured mentioning of the word inflation amongst U.S. corporate earnings calls for Q1 2021 have basically hyperinflated, moving more than 300% in April to then near 800% above the measured norm by May 2021. Basically, anywhere one looks, the prices for goods and services have been rampantly rising. So deflationary talking heads will say the same old stuff like aging demographics and advancements in technology and bottlenecks, etc. will make the newest round of ramping inflation temporary. But I am strongly suggesting that by blowing out the fiat currency monetary bases as much as we have in the last 15 months or so, it's going to have long-lasting psychological changing inflationary effects. So what is inflationary psychology? Inflation is a psychological phenomenon. It's a state of mind that leads consumers to spend more quickly than they otherwise would, in the belief that prices are rising. Most consumers will spend their money on a product immediately if they think its price is going to increase shortly. The rationale for this decision is that consumers believe they can save money by buying the product now rather than later. Inflationary psychology can become a self-fulfilling prophecy because as consumers spend more and save less, the velocity of money increases, further boosting inflation and contributing to inflationary psychology. Now that last point about the velocity of currency is always going to look very tiny now that we've blown out the currency supply. My suggestion is that this is a psychological phenomenon. It boils down to each and every individual collectively and what they believe about where prices are going. And my suggestion is that most people in the world right now believe prices are rising. To finish this week's SD Bullion market update, I want you to see what are the commodity inputs for the often cited Bloomberg Commodity Index. There are various energy inputs near 30%, grains account for just over 22%, industrial metals over 15%, Monetary precious metals like silver and gold account for near 20%. Soft commodities like sugar, coffee, and cotton near 7%. And livestock like cattle and hogs just over 5%. The index is not far from a historic breakout, and even the mainstream financial media and commentators are having to admit the obvious. Have a listen.
Let's do it all with our commodities guest, Bloomberg oil strategist Julian Lee. And Julian, before we get into the specifics of oil, there was a great story out on the terminal highlighting if this was a commodity super cycle and this structurally inflationary regime that is underway. Do you see that?
I think this is a really, really interesting question. You know, is this something structural that's going to last, or is this just a post-pandemic bounce that's going to be temporary and is going to filter out? On the one hand, I think, you know, during the pandemic, we've seen people unable to spend on services, so they've been spending on goods. That has, I think, stretched supply chains, and it's obviously required a boost in raw materials to make the automobiles and all the other things that people have been buying. So there certainly is that element to it. But then you hear things like the infrastructure plan that you were reporting on just a few minutes ago, and talk of 1,000 bridges to be repaired in the United States, rolling out broadband internet connection. I mean, that's going to take huge amounts of steel, potentially copper, and all sorts of other raw materials. You've got similar things going on in other parts of the world, and you can really make, I think, quite a convincing argument that this is something much more than just a post-pandemic bounce.
That's all for this week. Once again, we wish a safe and happy 4th of July holiday to all our U.S. viewers and SD Bullion customers. And as always, everyone out there, take great care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.